Hey guys, it's Rudy coming at you live from Palm Beach in Florida. It is Friday. It is May what is the date? The 2nd. We're already a couple of days into May. And as you could tell by the video I made yesterday, I was doing some catch up to at least try and catch up to some of the comments on the channel because people have asked me about a whole variety of different energy stocks specifically that I either knew nothing about or knew very little about. And I still have a couple of outstanding sort of comments and questions to respond to. And the first one that I need to respond to is this one here from Commander Shepard. He asked me about Tourmaline. So Tourmaline, I'm pretty sure it's probably Tourmaline. It's a Canadian company, it's a gas company. I don't know much about it at all. I do know that they are into predominantly natural gas and their assets are in Alberta, in Canada. But anyway, Commander Shepard said, could you tell me what you think about Tourmaline? So I replied and I said, I don't know too much about Tourmaline, but I will take a look. Thank you very much. And I sincerely mean thank you very much because when you highlight these companies for me, it gives me a potential opportunity to explore an investment that might be good not only for me personally, selfishly, or otherwise for everyone on the channel. So effectively, what we are doing here, Commander Shepard and I, is highlighting Tourmaline to you and talking a little bit about it. And maybe you guys can let us know in the comments what you think while I have my espresso. Taking a look here at their chart, this is taken from Yahoo Finance. The ticker symbol at the top, TOU.TO, that means Toronto. It's trading on the Toronto Stock Exchange or the TSX. The price here would be in Canadian dollars because we're looking at the Canadian ticker symbol. So this is Canadian dollars 61.23. At a quick back of the envelope math, that's about 45 US dollars or thereabouts. Over the past 5 years, if you held Tourmaline long for 5 years, you would have had a return on your stock appreciation alone of 342%, which is quite stellar. It's actually quite phenomenal. I've mentioned previously in videos that if you can achieve 15% per year, you can double every 5 years. Well, this one's more than tripled every 5 years. And we're just talking about stock appreciation. We're not talking about a total return on investment, which we can talk about in a minute. You'll notice this arrow that I put here, 2022, it started sort of on this huge spike and then it kind of plateaued at around 60-ish dollars since then, 2023. So what we want to do is maybe take a look. If we go back to 2020, which is the COVID pandemic, of course, most energy stocks spiked after that, and the prices were pretty good too, especially for oil. And to be fair, today the price of natural gas is probably still cheaper than what it costs to produce. So natural gas has not had the same benefit as oil over that period there, but it did spike quite nicely and then it kind of flatlined here over the past 2 years or so. The PE ratio is a little bit rich for me, 17 and a half. I want to buy typically if it's in the current market, sort of below 15, because that's my average sort of S&P 500 right now. So the price, even at $61.23, looks a little bit rich at a glance if you look at the PE ratio. On the far right here, you can see it pays a dividend as well. We'll talk more about the dividend in just a second because there are actually three components to it. We look at the performance overview of Tourmaline here. We see the rate of year-to-date return, -7%. Is actually not bad from an energy point of view, even though the S&P composite or the TSX composite, the S&P TSX, it's sort of a composite of the entire index up just a smidge. Tourmaline down 7%. Many energy stocks are down much, much more than that, including the ones I talked about just yesterday. 1 year return is just -1%, but 1 year, the S&P TSX composite has generated almost 14, 15%. 3 year return, more kind of level pegging year, 2020. But look at the 5 year return. And this is what happens when you also include your dividends, special dividends, and other distributions from the company. Now there's just no comparison at all. We have Tourmaline up almost 500% and the composite only up 70%. And by the way, 70% is not bad, but 526% if you had reinvested your dividends as well is fantastic. Down here at the bottom in the middle, I inserted a little Canadian flag because the comparison here are Canadian companies. And the only one that I've actually talked about before on a couple of occasions, Canadian Natural Resources. This is a great company. I'm not too familiar with ARC Resources and Whitecap. I am familiar with MEG, but that's just because just over 10 years or so ago, MEG Energy used to be one of my clients. I don't know too much about it today because I haven't been following it, but I do follow Canadian Natural Resources, a great company too. So between these two, oil and gas E&P, oil and gas E&P, it would be interesting to do a comparison between the two and then decide whether one is better than the other or preferred for whatever reason. If we look at some of the analyst takes on this, so this is Morningstar. They don't have a current report. The last one they published was 2021, so it's already 4 years out of date, three and a bit years out of date. So it's useless really because it's old. They have a quantitative equity report, which I did look at, but I don't really find anything of value in there. I like the equity analyst report from Morningstar because what it usually does is gives you a breakdown and says the bulls say and the bears say, which kind of gives you sort of an unbiased opinion because they give you 3 or 4 bullets for each of those two different scenarios, bulls and bears. They say the fair value is $64.85 Canadian, so it's sort of trading in that range right now. 3-star rating, not too bad. And quantitative valuations undervalued. However, on Trading Central, it says that the estimated rate of return is negative 21%, and the short-term, intermediate, and long-term sentiment is all bearish. And if you look at the actual analysts, and they've got quite a few analysts covering this because we have 19 analysts here on this particular website, which is RBC Direct Invest. We only have 4 holds. No one's saying sell it. 11 say buy it, and 4 of them are saying it's a strong buy. It has been downgraded recently. Previously it was a strong buy, and now it's a buy. So a little bit of a mix here. I'm not too sure what to make of that. Let's look at the company itself, though. Earnings per share is not a good picture. The earnings per share growth percentage has actually been trending negative. Net income growth, same thing, not a good picture. So just at a glance, you're looking at a 5-year period here. These pictures do not look too good, and the same applies to the dividends as well. So I'm not saying there's underlying risk necessarily, but it needs a little bit of a deeper dive to see exactly what's going on here. Of course, you could say the price of natural gas has been depressed, the price of oil has been depressed, and all the energy stocks are down in general. Um, which impacts some of these numbers. The dividends, probably have to look a little bit deeper into this to see what their free cash flow is and whether they can afford the dividend, whether it's sustainable or not. How about the PE ratio here? So I did mention it's a little bit high. So some of the companies, including Meg that I mentioned previously was a client of mine, uh, more attractively priced on a forward-looking basis at 10.5 times forward earnings. So there's a lot of stuff going on here, but this is not a good picture in general for Tourmaline. By the way, it's not all bad though. It's like you just have a bit of a mixed picture here. The net profit margin is pretty good, 23%. It's right up there with sort of its peers. Certainly way above average, which is only 10%, 23% is pretty good. But then look what happens to the earnings per share growth. So earnings per share growth at Tourmaline is below the industry average and worse, is declining. In addition, earnings per share growth at TOU was positive 5 years ago, but has since become negative with EPS trending downwards. This is not a good picture. The most recent earnings per share was 3.5, which is a decrease of 30% over the previous year. This is not good. And then sales growth as well. It's like Tourmaline is losing market share in a declining market. So the market's already declining and then they're losing market share in addition. This trend continues from the previous year when sales growth at TOU and the oil and gas integrated were negative 25 and 1.14 respectively. It's not a good number, this one. So, hmm, Commander Shepard, I'm not too sure here. tending towards if you're long in this position, I might want to just hold it for a while. I'm not sure it's a buy right now, and I don't think I've seen anything that puts you at risk in terms of maybe wanting to exit the position as yet. Revenue and earnings history. So the light line here, so the bluish gray line is revenue. So we can see it's taking a bit of a dip. This is not unusual, by the way, because many of the energy companies have taken a little bit of a hit in terms of revenue because obviously they don't control the price of the commodity. But the earnings per share has just kind of fallen off a cliff here. So there might be a little bit of a management strategic execution problem here. I don't know. I don't know the company well enough, but it warrants a better look before diving in. And by the way, when I say diving in, I always say no jumping boots and all. If you want to buy this, you just kind of nibble a little bit and maybe add some more if it goes down. But if it goes down too much, you don't want to catch a falling knife either. So it's not necessarily good. How about the value chart here? So the current price, that's the sort of $60 price right now. And then we have fair value and theoretical value, which does not look good at all. This is from Trading Central and it's current as of March 2025. So these pictures are not pretty either. So far, Commander Shepard, we are not looking too good. Let's see how this looks. The cash and equivalents have not done very well. I'll look at the balance sheet in just a minute. Dividends have been going up, 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 up. But what's going to happen going forward? We'll look at that in a minute too. Shares outstanding, so they've been issuing more shares, and the debt to equity ratio at least has declined or come down a bit. So, so I don't know. So nothing really looks particularly good. How about this? This is from the balance sheet. So if I look at the assets compared to the liabilities, so I've just extracted a couple of lines from the balance sheet. So in millions of Canadian dollars, this is as of December 2024, which is the last full fiscal year reported. We have total current assets 1.3, total current liabilities 1.5, right? So if you've been following my channel and watching some of my videos, you'll know that I frequently talk about the current ratio, which is what you're looking at now. It needs to be greater than one. So in this particular instance, it's below one, right? So 1 to 1 would be 1.3 to 1.3. But the assets are 1.3 and the liabilities are 1.5. So they're flying a little bit too close to the sun. Cheers. This is just water, not vodka. The current ratio wouldn't look too good here. And the other thing that you can do as well is instead of looking at the current ratio, you can look at the quick ratio, which is cash and cash equivalents or cash on hand and short-term liabilities. In other words, bills that have to be paid in the next 30 days or so. Just looking at this at a glance, I can tell you the quick ratio would be less than one as well, which is not good. The performance of the company has been phenomenal over the past 5 years, right? So this is just a 1 year graph. And the reason why I included these five musketeers here is because this is included in the video that I covered yesterday. I should call them the four musketeers because I'm going to just take another quick look at VARRY, which is VAR Energy, the Norwegian company, in a minute. But in 1 year, I mean, some of them have really done, let's say, not very well at all, right? So I'm not going to go into any depth on any of these because I talked about them yesterday, but I do want to revisit VAR Energy. This is over 1 year. How about over 5 years, right? So if we take a baseline here at zero, you can see that the only two that have actually done well using my baseline zero is uh, TOU and VARRY, VARRY, VAR Energy. VARRY is the OTC or over-the-counter ticker for people in the United States to buy VAR Energy, the Norwegian company. If we look at VAR, so I looked at it yesterday, right? So I'm kind of revisiting this here. VARRY over the counter, so OTC markets, right? So $5 over 5 years is up about 4%, right? So now this comes down to a sort of discussion about your personal investment thesis, right? So what is the timeline? The timing of your investment is less relevant. Time in the market is better than trying to time the market. But what is your timeline, your personal timeline? Can you buy the stock long and hold it for 3 years, 5 years, 10 years, whatever the case might be? Um, are you retired, or otherwise are you working? You have a job, and that's earning you a regular income. You know, uh, what kind of a return on investment do you need? Is your focus on capital growth or stock appreciation, or is it preservation of wealth? So these are things that only you can answer. I can't answer them for you. But if we look at the ticker symbol here, so let me just go back here just a second. This is from my son. He actually sent me a note just earlier, and he said, I've read VAR Energy's earnings call, and they seem very comfortable with their dividend going forward. Someone from Barclays, I'm sorry, I just accidentally exited my screen there for a minute. So let me just go back here again. And let me go here, go back to my screen over there. So my son sent me a note, and he said, I read VAR Energy's earning call, and they seem very comfortable with their dividend going forward. Someone from Barclays asked about it specifically, and they answered that they have a free cash flow of $5 billion going to $9 billion by 2030. And so they're running at pretty comfortable 25% or so. They also are expecting sales to grow from about 330,000 barrels per day currently to about 400,000 barrels per day by Q4, right? So when you look at VAR, and then right at the bottom on the right-hand side here, it's paying a dividend of 17%. If you can reinvest that dividend, you're already up 17%. If you get a little bit of stock appreciation as well, that's a bonus. But remember earlier I said if you can grow at 15% per year, you can double your equity position every 5 years. The PE ratio on VAR Energy at below 10 is much more attractively priced as well than Tourmaline. So what you have here is sort of a tale of two cities, right? So Tourmaline might outperform VAR Energy significantly from a stock appreciation point of view. And VAR Energy, in theory, would outperform Tourmaline significantly from a redistributed income point of view, where you are earning this big dividend that you can reinvest. And at the end of the day, it might be a bit of a wash, right? So if we look at the dividends for Tourmaline, they used to be significant, but now they're less significant. And that's also why I'm highlighting VAR, right? So it's kind of like a tale of two cities, because it really depends on what your objective is here. If I had neither of these in my portfolio, which by the way I don't, and I was interested in buying one or the other, I might be tempted to kind of split the position. If you going to invest whatever, so maybe split it 50-50 between these two, or maybe even a third one. I'll come back to that in a minute, because I showed you some of the Canadian peers, and we're also going to look at some of the US peers, so let me come back to that comment in just a second or so. But Tourmaline has a regular dividend. They also have a special dividend from time to time and an extra dividend. And you can see most recently in March, so just a couple of months ago, they actually paid a regular dividend of 34 cents, but then they added a special dividend of 24 cents. But look how the dividends declined from 2022 to 2024, where we are now. And then there's an expectation for 2025. It's sort of where it's at right now. So unlike the comment that I shared with you from my son and VAR Energy, you don't really have the potential reliability of a fairly high dividend. This is CFRA. They currently have Tourmaline at a hold. I would probably say you could hold this as well. If you are in the position currently, you've probably had a nice uptick. If you've been in it for 5 years, you've done really, really well. If you're up 350%, I mean, take some cash off the table, right? Sell half of it and let the other half just run and do whatever it does. Because by selling half of it, you've taken more than your money. So your own original investment plus a whole lot of profit off the table. And then you can let the rest just run relatively risk-free, right? Got a 12-month target price of 65 Canadian dollars, which is pretty much where it is right now. So they don't expect too much movement on the price. But look at this. If you had invested 10,000 Canadian CAD, so 10,000 Canadian dollars 5 years ago, that $10,000 would be worth $70,000 right now. So that's why I'm saying, I mean, like, sell half of it. If this is your example, right? So you put in $10,000 5 years ago and it's worth $70,000. Take profit, sell half of it, take $35,000 off the table and leave the other 35,000 to just grow and do whatever it does. Our risk assessment primarily reflects the company's exposure to commodity pricing, which remains volatile, right? Natural gas, very volatile. LNG project delays, GDP growth in Asian economies, and US political transitions all remain influential variables to the natural gas market as well. Also, Canada has just elected a new Prime Minister, Mark Carney, and we have absolutely no idea what his next thesis or objective it will be in terms of attacking um, the Alberta oil and gas companies. Peer and ratios comparison. So yeah, I've added a little American flag because what I'm doing here is I'm comparing Tourmaline, the Canadian issuer, to four international issuers, except two of them are American and obviously very familiar. Shell is a good buy. Total Energies is like a screaming buy right now. The PE ratio of only 9.7. Look at the net profit margin for Tourmaline, so 23.54. This is from Schwab, but it doesn't give you a timeline, so it doesn't actually say. It says earnings per share growth forecast 3 to 5 years, but it doesn't tell you the net profit margin. Probably if I had clicked on the eye on the website, it would have told me what the time period was. It might have been trailing 12 months. But anyway, very, very profitable, good company. So in essence, there's not a lot wrong with this company, Tourmaline. But Commander Shepard, there's also not a lot that's right with the company. So on this one, I'm a little bit mixed, right? So I said maybe you could sort of go 50-50 or something if you wanted to kind of uh, diversify just a little bit to mitigate risk, single stock risk, right? So what you could even do is you could consider building your own little index basket. So what you could do is you could say, from a Canadian point of view, I'm going to invest some money into Tourmaline, and I'm going to invest some money into Canadian natural resources. And then in order to mitigate risk even further, I'm going to buy Total Energies, which is super cheap. And then my steady Eddie foundational stock is going to be ExxonMobil. And then we're going to keep some cash. So if you want to apply an equal weighting to what I just said, let's just use a simple number and let's say it's $10,000. And remember, if you had invested $10,000 in Tourmaline 5 years ago, you'd have $70,000 now. So you could actually sell $50,000 worth of Tourmaline, and then you could do what I'm about to tell you you could do right now. So you could take the $50,000, or by way of a simple math example, you could say $10,000. I'm going to buy these four equities: Canadian Natural Resources, Tourmaline, ExxonMobil, and Total Energies. I'm going to buy $2,000 each, and I'm going to keep $2,000 in my back pocket in cash, right? So 20% cash is a little bit high in terms of holding cash. But then after you've made the buys, you can say, now I have an extra $2,000 in cash. If one of them unexpectedly drops just because of a bad quarter or something like that, but the fundamentals are sound, then I can buy a little bit more. And if one of them suddenly spikes and jumps, if you get maybe someone acquires Tourmaline or something like that, and the stock price quickly spikes or whatever, you could take some more cash off the table. But you could do something like that from a diversification and risk mitigation point of view in terms of single stock risk. Build your own little basket. As you know by now, I have a whole basket of energy stocks. I don't put all my money into one particular stock. I have two that are heavily weighted, where I have more than what I have in terms of my energy portfolio. I have two of them where I have more than what I have anything else, single stocks, and that's Energy Transfer, which is a limited partnership, and Alliance Resource Limited Partners, which is also a limited partnership, which means I have to file K1 tax filing when it comes around to tax time. So it requires a little bit of extra work, but I hold those because they pay such a high dividend. In the case of Energy Transfer, it's about 8% or so, 7 or 8%. And in the case of Alliance Resource Limited Partners, more than 10%. Right now, I'm leaning to potentially adding some VAR energy to my portfolio as well. And then some of these other equities, maybe Tourmaline. I'm not too sure about that one though. I'd rather add VAR energy, maybe open a small position in VAR. But that's where I'm at. You can tell me in the comments what you think. Anyway, Captain Shepard, that's the wrap. Talk to you soon. Thanks for watching. Take care. Bye.